Let's get straight into today's market action with our first guest. Joining us now is Saira Malik, Chief Investment Officer at Nuveen. Great to have you on. A lot of cross currents today. You had CPI that was largely in line with expectations. You have all this debate about what the Fed's going to do. You got bank stocks rallying, and then to top it off this afternoon, some geopolitics entering the fray and dinging stocks for a short while. Your take on the market right now and where we go from here?
We saw a relief rally today for two reasons, and that's some stability in the banking sector and a CPI that wasn't surprising. But I don't think we're out of the woods yet. Just looking at the banking sector that was already dealing with the repercussions of higher interest rates and the impact on net interest margins. And now after the Silicon Valley Bank debacle, we're going to be looking at potential capital raises, tighter regulations, and most importantly, the start of a consumer credit cycle, which puts us in the camp of when, not if, a recession. Now, looking at CPI, we're still dealing with sticky rents, which are remaining very high. And also, services spending is still high, and goods spending is not moderating at the pace we hope. Narrowing that down to what does the Fed do? I think 50 is off the table, but so is a pause. Most likely, they'll do 25 basis points to balance financial system stability with still high inflation.
So, Saira, people are breathing a sigh of relief that CPI was in line, as you said, but it's still really pretty high. And at the same time, the consumer's been taking on more credit, has lower savings. How does that resolve into the back end of the year? Because a consumer with higher credit and higher interest rates and persistent inflation, not a great combination.
Sure, and I think that's why eventually we have a recession that starts to correct this. But looking at inflation on a long-term basis, I think it's going to be tough for the Fed to get back to the 2% inflation level target. We may settle down even after a recession at higher levels than that. And that's often what we've seen pre the GFC anyway. The consumer and employment are keys to the depth of the recession. And the consumer has been strong, showing some signs of weakening with dipping into their savings rates, taking on more debt. I think, though, the banking sector is another crack for the consumer here because they'll start tightening their credit standards, and that weakens the consumer more. So now we're dependent on the employment market. And often you see the employment market crack right at the start of a recession. So just because payrolls remain strong doesn't mean that a recession won't come at some point.
Yeah, it's arguably the most lagging of lagging indicators when it comes to recessions. You keep saying if not when. When do you think, and what does that mean in terms of how you're positioned in this market right now?
I think that the indicators, watching the employment market closely is going to be one indicator of when a recession comes. And later this year or early 2024 will probably be when we start to see that recession take place. We're seeing cracks in manufacturing data, and these banking industry issues, if anything, start to pull forward the risk of recession. Last week, I'd seen some notes talking about perhaps a recession in 2025. I think it's more of a late 23, early 2024 issue because of many of the declines in the economy and now with the consumer that we're already seeing.